In today's video, I want to touch on 5 stocks, 5 companies that have the potential of doubling in the next 12 months. This is just a prediction, so it's not 100% accurate. Just so we're clear, a lot of things need to happen for that prediction to be correct. Macro-wise, industry-specific, company-specific, stock multiples maybe need to increase with regards to certain stocks here, and then you might get your 100% return in the next 12 months. Now, of course, with these types of stocks and types of companies, the risk profile is of course much different than buying a company like Costco, Microsoft, or Walmart or stuff like that. So allocate accordingly if you want to place those types of bets. Yes, I'm calling these things bets because we're talking about the next 12 months and not the next 12 years. Very important to note. Of course, I'm not going to waste your time much more, so here are the companies. And I do hope you keep watching, and if not, at least leave a like and a comment, would really appreciate that. And of course, hit that red button if you're new here. Subscribing would mean a lot to me. We're trying to reach 100,000 subscribers this year, so it's free. You can always unsubscribe later, but do wait until I get my YouTube plaque. Please, thank you very much. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And of course, these are just 5 stocks. There are probably a lot of other companies that I could have included in the list. Again, high risk, high reward types of things. I do still think that some of the Chinese stocks, the Alibabas, the Pinduoduos and stuff like that, have the potential to double as well. Of course, depending on geopolitical stuff and all of that. You've got companies like maybe Rivian and Mobileye that could also see a 100% return. Again, if some things happen with these specific companies, with these specific industries as well. Just so we're here, I just picked these 5 companies because one, we covered these companies before, and I still think that the price is, let's say, correct for the prediction to make sense, if that makes sense. Anyways, let's start with company number 1. And that might be the most controversial one because 1, it's a Chinese stock. 2, we are big Tesla bulls here. So I know a lot of you will say, oh, NIO this, NIO that. But let me explain. So NIO right now still trading under $5 at $4.36 with a market cap of $9.17 billion. Over the last year, this stock is down 30%. Over the last 3 years, we can see actually that this stock is down way more than that. Over the last 3 years, the stock is down close to 86%. Now, despite all of that, revenue-wise, this company continues to grow at a rapid pace. As you can see from the analyst expectation in fiscal 2025, sales expected to increase by 42.71% and then another 22.64% in fiscal 2026. But the problem here is that the company will remain unprofitable. If we look at the average analyst price target, that sits 41.7% higher than the price we're at today. And so if we look at the projections, we've seen the big acceleration in revenue growth, but what about net income and free cash flow? Well, if we look at fiscal 25 and fiscal 2026, both of them still in the red. But in the meantime, what we are seeing is an improvement with regards to gross profit and gross profit margin. Of course, we did peak. We are quite far away from the peak here of 19.1% back in 2021. We went as low as 4.4% back in Q3 2023, but now we're sitting above 8%, quite closer to 9%. We also got some monthly delivery numbers. So for December, that was an amazing quarter for NIO. As you can see, huge jump. December was quite a strong month across the board, not just for NIO. We also got the NIO brand monthly deliveries. We've seen a recovery there as well in December. And the Enphase brand continues to do quite well. That's their sub-brand. So all in all, if we look at NIO's annual deliveries, that did grow 38.7% year over year. And they expect that number to, double in 2025 to reach around 440,000 units. Of course, whether or not that will happen remains to be seen. A lot of the predictions went already wrong in the last couple of years. A lot of people have been telling me that NIO should have $50 already 2 years ago, but okay, we know that didn't happen. But right now, sentiment can change quite rapidly here. I've also seen some rumors that NIO might be acquired by another Chinese company. Let's see what happens. But at the current prices, the current growth rates and all of that, I do think that NIO does have the potential to double in the next 12 months. Of course, if they continue to grow revenue, if gross profit and gross profit margin continues to go up. From a profitability standpoint, yes, that's going to take a while, but until then, I do think that the stock could reach $9. What do you think? Let me know down in the comment section below. Moving on to the next company, and that's Enphase Energy. Enphase Energy has a market cap of $8.6 billion and a forward PE of 19.1 times. In the last 3 years, this stock is down 55.4%. And in the last year, the stock is down 41.43%. If we look at the analyst expectation, we know that fiscal 2024 is a horrendous year for the company, but that's expected to be much better in fiscal 25 and fiscal 2026. Looking at the average analyst price target, that sits 42.4% higher than the price we're at today. And here we actually have some pricing metrics to work with, so we can see that the forward PE, EV to EBITDA, price to sales, price to free cash flow, all below the 5-year mean, and price earnings to growth sits at 0.78. Anything under 1 is by definition undervalued. Despite the huge drop in revenue, this company still generates free cash flow, and free cash flow is expected to grow in fiscal 25 and fiscal 2026. Of course, with Enphase, you can clearly see when it peaked back in 2023. That's where revenue peaked. That's where free cash flow peaked as well. High interest rates does damage these types of companies. So the question will be in 2025, have interest rates come down significantly or enough already for people to start buying again? One of the indicators will probably be microinverters shipped. As you can see in the last 12 months, a huge decrease, not just from 23 or 22, but also from 2021, when actually back under the number we've been in 2020. So that could be an early indication if the company sees already some improvements. It comes at no surprise that, of course, the majority of their revenue comes from US and then the rest internationally. We do expect internationally to see a later rebound than in the United States, different economies, so there is that. And I know that a lot of people think that with Donald Trump coming in, he's going to hurt companies like Enphase, like First Solar. I don't think that's going to happen. I think he's going to make sure that US is leading when it comes to energy, and especially if those are US companies that are also building in the United States. Enphase fits that description. So here as well, you have a couple of things that need to work out for this stock to double. You will definitely notice that already in the next couple of quarters and earnings calls, when management will talk about a recovery or signs of recovery in the United States, demand, supply, and all of that. You will get your answers quite early on. Moving on to stock number 3, and that's Celsius. Celsius has a market cap of $6.4 billion. And year on year, the stock is down close to 55%. As you can see, in fiscal 2024, EPS is expected to take a hit around 12.5%, but then in fiscal 25 and 2026, we see a considerable uptake in growth rates for sales and EPS. The current average analyst price target sits 46.3% higher than the price we're at right now. And here, if we look at some pricing metrics, same thing, forward PE, EV to EBITDA, price to sales, price to free cash flow, all below the 5-year mean. Of course, previously, you would understand why there was a higher premium on the stock, because the stock was growing quite rapidly, but still, it is much lower than the 5-year mean, and price earnings to growth currently sits at 3.9, but that's because, well, earnings is taking a hit, so we have to wait until next quarter and then we get a better calculation here. Or of course, we can do that ourselves. We look at the current price, we look at the expected EPS for fiscal 25, and we look at the growth rate. So the price earnings to growth would be 0.78. And Celsius, just like with Enphase, this company still is generating free cash flow. Free cash flow is expected to grow 7.2% in fiscal 25 and accelerate in fiscal 2026. Growth there would be 32.5%. We have seen a huge decrease in growth rates. We've seen also a big uptick with regards to revenue. Of course, the majority comes from North America, then Europe, then Asia Pacific. They are expanding internationally quite rapidly. So I do expect international to become a larger chunk of the revenue eventually. But what we're also seeing right now is that Pepsi, as a percentage of total revenue, is decreasing. This is basically also one of the reasons why we've seen weakness in Celsius. Pepsi previously ordered a lot And then, well, they were left with quite a big inventory and they wanted to cut down on that inventory. And that's why we're also seeing that Pepsi's percent as total revenue did come down the last couple of quarters, and Costco and Amazon did come up a little bit. So we'll have some easier year-over-year comparisons in 2025, and I also expect Pepsi to start ordering back. Back in December, we did get some, let's say, semi-useful numbers here. So energy drink sales accelerated to 7.7% year on year for a 4-week period of retail sales tracked by Nielsen that ended on November 30. Monster Beverage saw energy drink sales increase 3.6% year over year, while Celsius Holdings saw its sales grow slow to 5.9%, and its market share retreated back to 8.8% after being as high as 9.7% in September. So both of them seeing growth slower than the overall energy drink market. They continue by saying here that Monster Beverage saw a price mix increase of 5.2% during the tracked period to offset a 1.6% drop in volume, while Celsius saw its 10.1% volume growth help to offset a 4.1% decline in price mix. And remember, last quarter, Celsius still told us that, well, they are growing the energy drink category. So here as well, with Celsius, a couple of things need to go in the right direction. Orders from Pepsi, good, let's say, results from the expansion internationally. And I think that will already be enough to push the stock higher. Of course, the year-over-year comparisons here will be quite helpful. Moving on to the next company, that's a company we touched not so long ago, so the full video will pop up in the top right corner. And that's Snap, parent company of Snapchat. Snap stock is down 30% year on year. In the last 3 years, it's down 71.45%. It has a market cap of $18.2 billion and a forward PE of 30.1 times. This company here, you can clearly see why I'm putting this again on the list. It's because, well, the bottom line is expected to grow much, much quicker than the top line. And I know what some of you will say, oh, but shareholder value has been destroyed by this company over the years. Look, it's down 71% in the last 3 years. And if we look at shares outstanding, that's also up a lot, although in the last 3 years, that's up 4.19%. And that's correct what you are saying. But again, I'm not buying Snapchat of the past, I'm buying Snapchat of today and the future company. That's the big difference. Right now, the average analyst price target sits 21.3% higher than the price we're at today. And looking at some pricing metrics, of course, comes at no surprise that as this company becomes more and more profitable and the stock continues to go down, well, the pricing metrics are, of course, lower than the 5-year mean. One of the main reasons why I put Snapchat on this list is because, well, their growth of free cash flow or expected growth of free cash flow. As you can see, in fiscal 2025, that's expected to grow another 112% after 578% growth in fiscal 24, and then another 65% growth in fiscal 2026. We can also see that the upcoming earnings report that they're going to release in the next couple of weeks is going to be where the company basically turns a corner. As you can see, net income, not net loss, and that is expected to continue from here on out. Me personally, I was never a big fan of Snap. I always ask the same question, who actually uses those apps? And apparently people still use it and the user base keeps on increasing each and every quarter. So I guess somebody is using it. The problem, of course, has always been about the monetization part and to, well, make sure that the company starts returning some value to shareholders. And I do think that after listening to the last couple of earnings calls, I think that's exactly what's going to happen. Plus you get a call option on AR, augmented reality. And then, of course, there's the TikTok ban. If that truly stays banned, first of all, great. Gen Z can finally go and touch grass. And second of all, that's definitely going to help push up companies like Meta, Google with YouTube, and Snap. Of course, you're just replacing one poison with the other. But then again, it's a free world, so you do whatever you want. Moving on to the last one, and that's Lyft. I covered Lyft not so long ago on the channel, so that video will also be in the top right corner. Lyft currently has a market cap of $5.56 billion in the last 3 years. This stock is down 67.5%. The last year, the stock is up 7.28%. Yes, there was a rumor more recently that maybe Amazon might acquire the company, but we did a video about that. I don't really think that's going to happen. It just doesn't make much sense. If you look at the forward PE, that currently sits at 13.2 times. and you look at the expected growth rates, it's quite good top and bottom lines. Top and bottom lines meaning sales and earnings. Looking at the current average analyst price target, that sits 41.7% higher than the price we're at today. And then looking at the pricing metrics, as you can see, all of them also below their respective means. With Lyft, it's also quite simple to explain. Stock is down a lot. We can see that the company is becoming more and more profitable. We can also see that active riders are going up slightly. We can see that the number of rides have increased quite a lot, and revenue per active riders has increased significantly in the last couple of quarters. From a profitability standpoint, you can see the trend here as well. It's becoming better and better. And then looking at their medium-term targets, so the 2027 targets, they expect gross bookings to grow at a compound annual growth rate of 15%. They expect adjusted EBITDA margin of 4%, adjusted EBITDA of $1 billion, and free cash flow closer to $900 million. And they say here free cash flow as a percent of adjusted EBITDA should be over 90%. They also talked about Lyft Media Platform and how that is going to be a profitability catalyst. So they expect gross bookings from Lyft Media to be over $400 million by 2027. And I know, autonomous vehicles. Lyft has partnerships and agreements with the likes of Mobileye, Maxar, and some other players as well. So they also are not sleeping at the wheel, pun intended. But yes, it's true that we've seen Waymo take already market share in San Francisco. But the point here is, again, that is true. That is a ugly and maybe great headline if you own a Google like myself. But if we looked at the data, what do we see? We see Lyft growing. We see Lyft becoming more and more profitable. So again, there is a disconnect here. I might not want to own Lyft for years and years ahead. I'm actually an Uber shareholder. But for the next 12 months, I still think that the disconnect is big enough to have a super positive reaction from the stock. If they can keep growing, if they can show the profitability of the business becomes better and better, I do think there is 100% upside in the next 12 months. Of course, there is definitely risk attached to it, not just to Lyft, but to all the companies mentioned here in this video. So what do you think? Let me know down in the comment section below. If you own any of those companies for the short or long term, let me know as well. And I'll see you all in the next one. Bye-bye.